So welcome everybody to the Tory Burch Foundation's Small Business Webinar Series. Today's session is Equity Financing Essentials. And I'm Molly Heffernan, Director of Marketing for the Tory Burch Foundation. And I am beyond thrilled to introduce Kim Seals. Kim is General Partner at the Jump Fund, a women-led venture firm that invests in women-owned businesses in the Southeastern United States. The fund focuses on early stage tech, fintech, healthcare, energy, consumer product companies, and Kim has over 25 years of global expertise in human resource consulting, corporate, and leadership roles. To say we are in good hands today is an understatement. So we are just so thrilled. Kim, you're here to talk to our community about the kinds of companies that investors look for, how to prepare for those pitch meetings, and really maximize investment opportunities. So Kim is going to do a presentation. After that, we are going to have plenty of time for Q&A. I am sure that there are going to be lots of questions, so please use the Q&A box because that chat moves quickly and we don't want to miss any of the questions. We'll do our best to get to as many as we can. A reminder about the chat, please use the everyone dropdown if you're looking to chat to the whole group, and then questions again in the Q&A box. Today's session will be recorded, and you can check your inboxes for a replay link afterwards. So I guess with that, Kim, over to you.
Thank you, Molly. Appreciate it. Hi, everybody. Welcome to today's conversation. Hopefully, you can all see my screen, and we'll go ahead and just dive right in. I'll skip the introductions page since Molly's already given you my quick bio, and jump right into today's conversation. What we want to make sure that we talk about today and really understand that any funding decision you make for your company is typically going to be made once you think about all the trade-offs that you have to consider. What's the cost of me getting this funding? How will I pay it back? How will I spend the money? What is my real need for this cash? And then the most important part of what we'll talk about today, if I start the first check, the first dollar I take from an outside entity or party, what does that mean to ownership and control implications of my company that I've been building and where I want to take that company in the future? So if we think about that, I'm going to ask you to start with the end in mind. What is your end game for the company that you are working so hard to create? You really need to understand that very explicitly before you have a funding strategy, because each of these three buckets that I've listed here, they have different implications for how you might want to think about funding. So first of all, let's talk about what we in the investor community call a lifestyle business. This is a business that will be a profitable, viable, very nice company for you, but you don't intend to exit it. Perhaps it's something you want to keep in your family for generations, or it's just something that you're so personally passionate about. This is going to be your business, your baby. You're not going to sell it. It's really important that if that's your plan, then we think about what is the right funding strategy for that plan. Because if you take on outside investors, they're going to expect some kind of return on their capital. And typically that involves these other two boxes. Either your company gets acquired or you take it public and you sell shares in your company. So if you are in the first bucket and you have a lifestyle business, there are certainly plenty of options for how you can grow and scale your business and take on capital, but you probably don't want to give away equity in your company unless it's to somebody else who's perfectly fine with this is an investment that I'll be hanging on to. So let's talk about crowdfunding. Let's start there. It's actually one of the most popular topics I get asked about in terms of a funding strategy for your business. You can raise capital through a collection of individual investors, or you can take on funding through crowdfunding that doesn't give up equity. So let's talk about these three types. The first one is donation-based crowdfunding. So the people that invest or give money through these donation-based crowdfunding sites, they're not expecting a return. They're not expecting to get their capital back. they're typically expecting it to be some type of disaster relief or nonprofit power, or helping someone with an unexpected emergency. So, typical example there, a GoFundMe site, right, that people spin up for a number of reasons, whether it's a personal health or emergency situation. They're looking to raise money for big events that have happened around the world, or I've even seen them like, my pet needs surgery and I can't afford it. Will you help me fund that? So that's that donation-based crowdfunding where you go out and get money, and it doesn't really, no one's expecting to get their money back. They know they're giving it away. The second bucket here, the rewards-based crowdfunding, this is the Indiegogo, the Kickstarter. This is a great solution if your business is a product or service that you can sell in advance directly to consumers. It serves a number of purposes here. First of all, it's a great way for you to prove traction. It's a great way for you to test the market and see if people are interested in buying what you want to sell. The second is you're pre-funding your ability to create the product or service. So people are paying you in advance, and then later they get that product or service. So it's a great way for you to also collect the funding you need to actually build whatever the product or solution is. So let's say I knew a lady that was trying to put together a company that was making purses. So this was a great way to identify what styles would be most popular, who would be interested in paying this price point for the purse. And then at the end of it, she had the funding she needed to actually go create the product and get it on the market. And we as investors, if we're investing in these consumer products organizations, we like to see the results of these crowdfunding campaigns because, again, it shows us your traction. The third bucket that we'll spend most of our time on here today is equity-based crowdfunding, where you're going out and sourcing investors, but you're giving them equity in your company. That's what they're actually investing in. So you are giving up ownership and taking on outside investors. So how does that work? So basically, you as the founder will set up a company profile on this equity crowdfunding site. You'll build out basically an online pitch. You're responsible for getting the word out initially. Okay, you are supposed to invite your customers, your friends, your family, your colleagues. They give you advice on how to set up and start sort of a social media campaign, if you will, so that everybody is aware of your crowdfunding and you can start to spread the word. You might take on, let's say you take on 100 investors through your crowdfunding. All of these investors are typically going to be aggregated into one, what we call SPV, or special purpose vehicle, so that there's only one entry on your cap table. So if I came in on your crowdfunding and Molly came in and Desiree, whomever might come in, we're all going to put our individual money in, but we're going to have one legal entity that we form to take everybody's money and be one entry on your capitalization table, or cap table, as we say, which shows the ownership of the company. There are a couple of things you should be aware of, though. The number one is there are legal requirements for you to disclose your financials. You're going to have to create an annual report. And there are some more comprehensive steps you have to take when you take on equity crowdfunding here. So just something to keep in mind. And also be aware that these funding platforms can take a percentage of the funds raised as their fee for providing you the platform. So you need to factor that into the calculations of how much money you want to raise, you're looking to raise. Make sure you know that the more money you raise, obviously, the bigger the fee. It's tied to how much money you raise. But keep that in mind as you're thinking about how much money. If I need $50,000 and I have to pay the site, 7% of that, then perhaps I need to be trying to raise $60,000 so that I net 50. So just keep that in mind. As with any equity you take on, there are pros and cons. And so let's talk a bit about pros and cons of equity crowdfunding. The first, on the pro side, it's really nice to have a fundraising portal. If you're trying to do this and keep track, I know a lot of founders who have these elaborate Google Docs, these spreadsheets, where they're tracking who did I talk to, what did they say, what's my follow-up. When you go to some of these crowdfunding, equity crowdfunding sites, you'll have a funding portal that will make it really a lot easier for you to concentrate all of your conversations and track them in one place. You can use this portal to create engagement so that the investors that you're talking to, they can become advocates for the company, right? Once you've gotten these investors involved and engaged, a lot of times they want to make sure they're really supporting you, they're introducing you to customers. So it's a great way to create engagement around what you're trying to do. When you look at these crowdfunding sites, some of the most popular, most active ones get featured in their newsletters, they get talked about on social media, they're shared with by other users, to other users. So you can really create a nice network effect if you do this well. And likely you're going to pick up a pretty diverse investor base of individuals who like to use these equity crowdfunding sites to find their next investment. Again, there are some cons, just like there are with any type of money that you want to take in. The first being dilution of ownership. When you do this equity crowdfunding, you are giving up ownership of your company, and that dilutes your personal ownership as well as the ownership of other early investors. As I mentioned earlier, there's legal and regulatory compliance requirements. Those can cost you money. You probably would have to hire an accountant. You'll have to have some legal advice. They can be time consuming and can cost money. So again, factor that into how much money you're going to raise. Understand, I'm going to have these implications that'll cost me money later. The public disclosure that we talked about already, and then the fees that these crowdfunding platforms that they take. So again, all important considerations when you think about, is equity crowdfunding the right way to go for me? And I've seen a lot of companies successfully raise on equity crowdfunding sites, so it's definitely worth your consideration. Let's talk about a few terms that you should know as you think about investors and how I'm going to fund my company. The first is a term called bootstrapped. This is a term that's used when a company is entirely funded by the entrepreneur's personal money or revenue, that paying customers, in other words, and it comes from the phrase of pulling oneself up by one's bootstraps. That's where the term bootstrap came from. So if you hear that, hey, oh, this company's bootstrapped, what that means is they're not taking outside money. Either the founder put their own personal money in, or they have paying customers, and that's how they're growing and scaling their business. When we talk about due diligence, what we mean there is the process that investors go through to validate that the information you've given them is correct. And any good investor will do due diligence with you before they actually hand over the check. So you'll need to consider how much information you have that you can share as part of this due diligence. And we'll talk a little bit later on about where this falls in the process. But be ready for an investigation, if you will. I use that term lightly, in terms of they want to look at everything. They want to see financial statements. They'll probably want a demo of technology. They'll want to check some customer references. So there will be a period of due diligence. Your lead investor is another important term to know. This is the individual or venture capital fund that will lead your round and help you set the terms for how you're going to take on the money. So if you're going to raise money through a convertible note, for example, and you're going to take on that type of fundraising, your lead investor will help you set those terms. Then last but not least on this page is the valuation, which is the process that you'll determine how much is my company worth. You'll look at a number of different options before you'll figure out what your valuation should be. And later on, I'm going to give you a few examples for how you think about that. The next quick term we want to go through is a term called stage. And a lot of times you'll be asked by investors, what stage is your company at? So that they can determine, is this too early for me? Is this too late for me? Or is this right in the sweet spot of where I like to invest? Typically, It's defined as a seed stage company, which is very, very early, or a company with that is considered early stage. Maybe you have one or two customers. A mid-stage company that typically has a lot of traction and we can see where this company is going. And then a later stage company typically could be ready for an exit event or something else, but they're pretty later stage in their evolution as a startup. The next question you'll likely be asked is, well, what round is this? What round of raising capital is this? And again, you'll start usually with your seed round. And by that, again, it's you're seeding your investment in the company so that you can get it going, scale it, grow it. And then after that, it goes alphabetically. I have my Series A, then I have my Series B, then I have my Series C. And it goes on from there. I've seen companies raise around D, E, and F. So, you know, it really is pretty easy to sort of numerically or alphanumerically track them post-seed round. Exit, we've talked about this a little bit earlier. The exit is the method with which you're going to get your investor a return on their investment. Either you're going to sell the company, you're going to take it public. How will you exit the investment for both you and your investors? And then finally, a term sheet. What is a term sheet? It's not a contract. It's a non-binding piece of paper that lays out what the terms are for you taking on this money. What will I get as the investor? What will you be giving up as a founder? What are the terms by which you're going to take on this outside money? It's a really important piece of paper, and it's one that you and your lead investor will put together in partnership, and you'll take it out to other investors to explain to them how you're raising the money. So what type of investors could you be talking to? Generally speaking, given the stage of companies, I think most of you all have in terms of, you know, seed or early stage companies, you're likely talking to one of these three groups. You're typically talking to solo angels, which may be individuals who had their own startups and maybe they exited those startups and they have a lot of cash from those exits and they want to pay it forward. They want to invest in other companies. So they typically are individuals writing checks to you based on something they're personally passionate about or super interested in investing in. And that's what we call a solo angel. However, a lot of angels get together and form networks because there's more power in the numbers of individuals. We can raise more capital that way. You typically pay a membership fee as an angel to get into this, this group. And you get deal flow, you share deal flow, but you are making an individual decision. So if I'm in an angel investing network and 10 other people are in that network with me, we'll look at a company for investment. And each of us, all 10 of us, we each make our own decision about whether we're going to write a check. So I might write a check, but somebody else might not. But it gives you, as an entrepreneur, as a founder, it gives you access to more angels at one time. Talking to individual solo angels, that's a lot of time and effort, right? Individual meetings. If you can get in front of these networks where you might have 100 angels in the room and you're pitching one time, again, you're increasing your ability to raise money faster. Angel investors, whether they're solo angels or angel networks, they typically write smaller size checks, but they invest in more deals, right? So they are trying to build their own personal portfolio. And you know, so I am both an angel investor and I'm a venture capitalist. So I have individual deals where I've written checks direct to entrepreneurs, and I've created a little portfolio for myself of companies that I've invested in, so I don't have all of my investment tied to one company. So tend to write smaller checks, maybe $25,000, $50,000 as an individual angel in a bigger number of companies. But when you get to venture capital, these are groups where they've taken on limited partners who have put money in their fund. And then these venture capitalists are investing out of the fund on behalf of everybody who's put their money in the fund. They're typically writing bigger checks, so maybe $250,000 checks or more, right? They could write $1 million check. but they're investing in fewer numbers of deals. Okay, so it takes them longer to write a check because, again, they're representing a whole bunch of other investors who've given them their money. They tend to take more time with due diligence. It's a longer process to raise money for venture capital. So you might be saying to yourself, well, how do I know who I should go to, right? It really is going to depend on how much money you want and where is your company in its evolution. To go back to the term I gave you earlier, what stage is your company in? Do you just have a great idea, but you haven't yet developed it into a company? Do you have what we call an MVP or minimum viable product that you have out in the market? Have you already started to get traction and you have a number of paying customers? Are you really on a significant growth trajectory? And then are you a pretty mature organization that has less risk? So step one is figure out where you are in your evolution or stage of your company. Based on that, you'll then determine where should I go to get money. In the early days, when I've just got a good idea, but I maybe don't have paying customers or maybe don't have it all figured out, I'm likely bootstrapping it, or I'm getting money from friends, from family, from these solo angel or angel groups we talked about. Maybe I've gone to get a grant. Maybe I've got a grant in some way to help fund what I'm trying to do. Or you might find a venture capital firm that invests very, very early, what we call seed venture capital. So there's a number of ideas, or a number of ways you can raise money to get you from I have a great idea to I have traction. Once you have traction, it's a lot easier than to get in with the venture capital firms and start to get those bigger checks. And then finally, as you're have a more mature entity, a more mature company, you're likely dealing with private equity money, or you're able to get bank loans a lot easier. Perhaps you've gone out to the public markets and IPO'd your business. Any number of ways. You have a lot more options when you're a more mature organization. So let's talk about how you might want to structure your round. And by that, I mean, what is the instrument that you will use to actually give money? What is the legal document? The first, and one of the most preferred by investors, is that you give them equity in your company. And by that, they give you money, and in exchange, they own a part of your company. They have what's called preferred equity, which means they have voting rights, so they can start to have involvement and tell you a bit about how they think you should be running your company. So it's a really important step and something you should think about. Do I want to give up? When do I want to give up equity? If you're a newer company, you might say to yourself, I'm not ready to give up equity, but I do need to take on some investors. And in that case, you may want to do this, what we call a SAFE, this simple agreement for future equity. It's a very simple legal document, and it really states very plainly, you're giving me money today, and I am in the future going to give you equity in my company. But today, I'm not giving you any equity. I'm just putting you in line to get equity later. These are generally intended to be very small, modest amounts of raises, typically a few $100,000, where you say, I'm just going to put this simple agreement in place, and then we'll figure out equity later. And then the third option is a little more structured than a SAFE, but it is basically a note, a loan, right? So the company is borrowing money from a potential investor, but the payback of that loan will be equity in the future. And the reason you would do that is it delays you having to put a value on your company. It delays you giving up equity until perhaps the company has more value, so that the amount of equity and ownership you're giving up is less. It buys you time, in other words. It gives you the chance to get your company to a bigger stage of growth. So how might you value your company if you don't have revenue yet, or maybe you're really early? The things you can think about there are, do I have any paying customers? Do I have a prototype? Do I have any proprietary software that I've got a patent on? Do I have any partnerships that I think will help me get to paying customers? So there's any number of ways you can value your company before you have revenue. Once you have revenue, the valuation of your company is likely going to be some calculation or multiple of the amount of revenue you have. So this is just a way for you to say, in the early days, how much money do I think my company is worth, so that I can figure out how much equity I would be giving away if I raised money. So let's do a little math together. Let me sort of pull it all together for you in a formula. Let's say that before you raise any money, you decide your company has a valuation of $4 million. And you came up with that valuation by saying, I've got a prototype, I've got, I've got a really sound idea, I've got a really strong management team. Based on all of these factors, I've got this partnership deal that I'm making. I think my company's worth $4 million. And then you say, I'm going to go raise $2 million from outside investors. So after I raise my money, my company is now worth $6 million. So I had the $4 million that I originally said I thought my company was worth. I had my $2 million that I've raised. And now I have a valuation, what we call a post-money valuation of $6 million. So then you say to yourself, all right, well, how much of my company did I just give away in equity for that $2 million I raised? The math is the 2 million minus the 4 million. I'm sorry, that should actually say 6 million. I'll correct that. That should say 6 million. That gets me to my 33%. That's the equity that I just gave away. So is that normal? Giving away 33%? Is that what I should have done? How does that work out in terms of the math? Well, I mean, there's no right or wrong answer on this. You have to decide how you think about your company and how much equity you're willing to give away. In the early days, before you've taken on any outside investor, you own 100% of the company. Then you do your seed round and you take on some outside investors. And typically you're giving up somewhere around 25% of your company. That's the general recommended amount. But then as you start to raise more money and you get into these later rounds, like your Series A, a lot of times you've diluted pretty close to 45% of your company, if not more, where you as the owner you as the founder still only own about 56% of your company. It might be interesting for you to know that companies that take it all the way to an IPO, the median level of ownership they still have at that point in their company is only about 11%. And you may say to yourself, wow, that's not much. But if you think about how big the company typically is by the time that you're in an IPO situation, your company could be worth hundreds of millions of dollars. Well, 11% at that point is not bad at all. But it just goes to show you that as you take on more outside money, you're diluting your ownership so that you don't own as much of the company, obviously, as when you started. So that's the most important consideration for you, is how much ownership in my company do I want to maintain? And the easiest way to avoid giving up ownership in your company is to have paying customers. And that's where you get your money to continue to grow and build, and you don't take on outside investors. All right, so how do you find the right investors? The first piece of advice I'll give you is to do your homework. As you're thinking about investors, look at other companies that they've invested in. Who else is in your space doing what you do, and who invested in them? Understand the investment thesis of these investors. Like, what type of companies do they really want to invest in? Do they only invest in consumer products? Do they only invest in technology? Are they a clean tech energy investor? Make sure you do your homework and understand their target sectors, what stage of companies they invest in. Do they have a geographical preference? Are they looking to invest in diverse founders? Do you have any relationships or connections to them that can help you get an introduction? What's their reputation as an investor? That's super important because you should be reviewing these investors the same way they're reviewing you. Is this somebody you really want to make this deal with? Is this somebody that you think you can work with over the next many years as you're growing your company with the money they've invested in it? So be sure to do your homework and understand who these investors are and what they're going to bring to you. As an investor, what do we typically care about? We care about the integrity of the founders, their quality, their passion, their commitment to what they're doing. We care about the market opportunity and how big it is. So if you bring me an idea, but the total addressable market is probably only about $20 million, I may say to you, that market's too small for me, because I know you're only going to get a small percentage of the market that you play in. So that doesn't seem like that could become a very big company. But if you have an idea and the market opportunity for that idea is hundreds of millions of dollars, then maybe I'm more invested in how can I help you get to that full market potential. We care that you have a really well thought out business plan and that you're able to give us some evidence that there is a market of buyers for what you're trying to sell. We a lot of times like to see some type of interesting technology or intellectual property that shows us that you're different. We want to know that it's a reasonable valuation, reasonable terms that you're trying to raise on. And we also want to know that there's a real possibility that if you needed more money later, you could have additional rounds of financing, because this is a company that's highly likely to get future investment. The funding process it can be long. So think about the timing of that. And it could be several months before you get a check. So don't wait until you're out of money to start this process. Start it early, start networking with investors, get a commitment from somebody who's going to lead, work through the details of the term sheet. Then you move to due diligence. Then we put together the deal documents, the actual legal documents. And then there's a closing period where you will receive the funds. It's kind of like buying a house to a certain extent, right? You've got to figure out how you're going to finance the house. You've got to figure out what the right terms are for how you're going to buy it. You do the inspection, you make sure the house is what you think you're getting. Then there's all the documents, and then the money changes hands. So it can take a while. And again, the best advice I can give you is start networking early with potential investors, get those introductions, get to know people, because this is very much a relationship-driven process. And have your materials ready. Here are the general things that you're going to be asked about throughout this funding process. The first, an executive summary. What is that one pager that you can send me when I say, hey, I'd like to learn more about your company? At this point, maybe I'm not ready to look at a full pitch deck, but I just want an overview of the company. Send me a one pager. Tell me a bit about what you're doing. Then I'll ask you for more information, right? Well, the pitch deck would be an important document for you to get together. It's typically only 10 slides, and I'll tell you exactly what's put in it. I've got another slide coming up to tell you what's put in your pitch deck. Talk to us about the market opportunity. What's the problem you're solving, and who are your potential buyers? How big is that market opportunity? Have some detailed financial models that show us how you're going to make money. Even if it's just your ideas right now because you haven't taken on any revenue, at least put a model together so we know what you're thinking about in terms of the revenue, where it will come from, what the price points are for your product or service. Have an elevator pitch ready. Anytime you're introducing yourself and somebody says, tell me what you do. You know, my name is Kim and I have a fund that does blah, 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 right? What is my 30-second pitch? And then be ready when somebody says, oh, that's interesting, tell me more. What do those next couple of minutes look like? How do you very cleanly and crisply tell your story in the quick time you have to make that first impression on me as an investor? Introductory email ready to go. Of your email. Oh, I'd be happy to introduce you to my connection at this other fund. But send me the email so that so make it easy for me to make that introduction for you on your behalf. And then you've got that introductory email ready to go. You can forward it to me and I can use it for me to introduce you to somebody in my network. So get your initial materials together and be ready to go on that. And then when I talked about the pitch deck earlier, I said 10 slides, right? And I really meant 10 slides. I've seen a lot of pitch decks that are super long. They're hard to get through. Keep it short and simple. It's fine to have an appendix if you feel like you've got some detailed slides you want to include, but your core pitch deck should be 10 slides. And these are the questions you should be answering. Answer one question per slide, if you will, right? What problem are you solving? What is your solution to this problem? Who has this problem that you're trying to solve? So in other words, who's willing to pay you to solve their problem? Who are your competitors and why is your solution better? This is an important one because I see a lot of founders get tripped up on this because when we ask the question, who are your competitors? You might say to me, I don't have any competitors. We actually think that's not a great answer as an investor. It might surprise you, but we don't think that's a great answer. Number one, because we might ask ourselves, do you really understand the market? Are you sure you don't have any competitors? And then the second thing we might say to ourselves is, well, is this a big enough problem if nobody else is trying to solve it? So just be careful with that question. I see a lot of founders sometimes, again, trip themselves up with that question. How are you going to attract customers and how much will it cost? What are your revenue and expense assumptions? Who's on your team and why did you choose them? How much money do you need from me as an investor and why do you need the money? How are you going to spend that money? And again, we're talking broadly speaking, how are you going to spend the money? So you might say, I'll spend 60% of it building out my product or service. I'm going to spend 10% of it marketing. And then I'm going to spend 30% hiring a team to help me build and grow my business. So when we say, how are you going to spend the money? We're talking broadly, big buckets. How would you spend this money? How are you going to give me a return as an investor? And then wrap it up with a really strong point of view about why should I invest in you? These are the basic 10 slides you'll need. And then that'll help you have a very structured pitch in that initial meeting. Remember, the goal of the pitch is not to get somebody to write you a check. I know that sounds funny, but I've never seen an investor write a check based on the pitch deck. What that pitch deck gets you is the next meeting. And in that next meeting, we get more into the details. We learn more, we uncover more, we get to know you better. So your goal in this pitch deck is intrigue me enough so that I can so I want to have another meeting with you and learn more about your company. And with that, I want to open it up for some questions. I think we've got right about 20 minutes left. Would love to hear some of the questions and share more information with you.
Yeah. Well, we have a ton of questions to get through, and I'm going to hop around a little bit, Kim, just to make sure I hit everything. But
Sure.
I guess to start, you mentioned, of course, having a solid business plan and early evidence that you are obtaining traction.
Mm-hmm.
I'd like to dig into this just a little bit more because it's something we often hear entrepreneurs maybe not quite nail that
Mm-hmm.
story. So what is obtaining initial traction? What are some examples of that?
Sure.
And what are some of the mistakes you see people when they're presenting what that means?
So, such a good question because it varies by industry. Okay. So when we as investors are looking for proof points, we're looking for traction based on what industry your company is in. Again, if you're in a consumer products industry, we're looking to see, have you tried to sell your product yet to a customer? We know individual consumers can be fickle. Maybe they'll buy it once, but would they buy it again? So we're looking to see, have you built a prototype? Have you tried to sell it? Have you thought about what your price point is? Do you have evidence that people are willing to pay for that? If you're in a business-to-business type technology industry, we might look for a pilot. Have you convinced somebody to get into a pilot with you and allow you to test out your idea? If you're in life sciences, we aren't looking for revenue because we know revenue takes a while when you're in life sciences because you've got to get through some regulatory approvals. So we'll want to see how are you advancing on the regulatory approvals. The other thing that we like that also shows us proof points are grants, believe it or not, because we can see that you've shared your idea with other people and they believe in you and they've given you a grant. So be sure to, in your pitch deck, when you're talking about traction, if you've gotten a grant from the Tory Burch Foundation or from Fearless Fund or whomever, put it in your deck because again, those are other proof points to us that you have traction. Somebody's liked your idea and it's a good sign for us.
Amazing. Okay, so we're nailing what traction means. Talk to me about some of the pitfalls around defining your market opportunity and not feeling like you have to, if your market opportunity is not hundreds of millions of dollars, but you present it as if it is, are you in fact hurting yourself? Talk to me a little bit more.
I actually see the reverse problem happen more, Molly, where I see people are much more conservative and they're like, well, I'm only selling to moms of twins. And so that's small, but the reality is you're selling to parents and you're selling to people who have this problem. And so so your market opportunity may be this big, but I'm going to start here, right? And I'm going to really zone in on the people that I think need my product right away, but I can get to this bigger market. Be sure to tell that story, right? We like initial focus. We like knowing that you're going to go target a smaller group to prove your point, to prove your hypothesis. But we also like knowing there's a bigger universe out there you can get to. So be sure to talk about it. Don't be afraid to promote yourself, to promote your idea and say, this is a big idea. I may be starting here, but this is really a big idea.
Great. Okay, I'm shifting gears to a couple of logistical questions. So someone wrote in, if I have an LLC, can I seek investors or should I change my business to a C Corp or S Corp?
We as investors don't really like LLCs. So even just because the paperwork, it's more paperwork, right? S Corps are so much easier for us to invest in. If you have an LLC, that means you have to give us a K1 at the end of the year. And that ties us up in waiting for the K1 because we're trying to create our tax forms for our investors. So there are investors out there that require you to be an S Corp before they will invest in you. So might as well start with the S Corp. Just go ahead and get it done. If you think you're going to take outside investors, a lot of our folks put their corporation in Delaware as, kind of the capital of companies, right? But go ahead and I would say go ahead and do the S Corp because you're likely going to get pushed in that direction.
Okay, great. And then another logistical question here. Can franchisees pursue equity financing?
Yeah. Oh, and C Corp. Yes, Kathy. Thank you for saying that. Yes, S Corp and C. So can franchisees seek equity? So you are the person that bought into the franchise. Yeah, I mean, anybody can, there's very few companies that you can't find at least one or two people willing to invest in, right? But you have to think about what kind of return are you going to give that investor? If you're a franchisee, I don't think you can necessarily sell that on your own. You might have to sell it back to the franchisor, right? So just be sure you're clear on, if I took on an outside investor and I have a partner in my business now, how will they ever get their money back? Are they going to get their money back when I sell it to my franchise to somebody else? So just think about those implications.
That leads to another great question that came in, which is really, we know investors want a return, but what else might they be looking for? What are they, money aside, are they looking to grow your company, prove their own track record? What are the other motivators?
Well, it may be those two things you mentioned, and it may just be it's a topic they're personally passionate about. So I'll tell you, as an angel investor, I invested in a company that was looking to solve the problem of noise-induced hearing loss. And it was a very specific problem, and it's a problem I personally have. So I was like, I don't really care if I get my money back. I want to help solve this problem. And it's something I'm personally passionate about. So I put some money in it. Ultimately, the company didn't work, but you know what? I tried it, right? So a lot of times with angels, we're going to invest in things that we deeply care about. And so in some respects, maybe we're not looking for you to make a big exit, but we're looking for you to help us solve a problem that we know either we have or other people have. That's what I like about angel investors, especially when you're first figuring out your idea. I'm also very willing to make introductions to potential customers. If there's somebody in my network that can help you in your network, I'm happy to make that introduction.
I love that, Kim. That's great advice. And I think leads to this other question about, you mentioned at the very top of the presentation, defining the lifestyle business. So that's, company you're looking to maintain and grow oneself. And you said that there was possibility of securing equity, but that it was very important to understand the objective there around investment. So what are some of the signs or things that somebody with a business like that who really wants to maintain control but does want some investment, what should they be looking for or aware of to make sure that that values alignment exists?
I think it's just asking the question of the investor. What are you looking for out of this investment? I've met a few investors that aren't looking for you to sell your company. They're looking for you to give them dividends because they want steady retirement income. Right. So that's an example of somebody who might be willing to invest in a lifestyle business. I want to share in your profits for the next 10 years. Right. So, and that's how I'll make my money back. And it's a great sort of annuity kind of revenue. Or folks might say, look, I'll just do this as a loan. You give me 6% interest and then pay me back in 10 years. Right. I mean, because somebody might say, well, that's a lot safer than maybe the return I might get in the market, given the market volatility right now. Who knows? But I think you've got to, what I say all the time, Molly, is that taking on an outside investor is the marriage and the divorce at the beginning of the relationship, right? So we're going to get married, but we also know we're going to get divorced at some point. So how are we going to get divorced, right? What does this look like? Am I, as an investor, somebody you would be willing to get into this relationship with? So you've got to ask those deep questions, like, how do you want your money back? What are you looking for in return, right? And you've got to get it figured out up front. The worst thing you can do is just take money because somebody offers you money and then you're not on the same page. And it's very difficult to pay out an investor you no longer want.
Yes, I would hate to part with that money, right?
Yes, yes.
So you mentioned several different ways that you could structure the relationship. Can you talk a little bit about revenue notes? It's a term we hear tossed around a bit.
Yeah, I mean, as an investor, I've not invested in revenue notes before. I know that is sort of like a latest craze, if you will, right? I'd say ask some questions again. What does that mean? Because if they're going to try to take your revenue, that's again revenue you need to be reinvesting. So I'm not sure that I'm fully up to speed yet on this whole revenue notes thing. It is a very new thing. I personally would rather have equity than revenue, but that's just me as an investor. Great.
Super helpful. And so a question got asked early on because I saw IPO on one of your slides. So the question is, do investors have a preference between acquisition or IPO? Or do we just find a VC that has the same exit strategy I do?
I think it's the latter. Find the investor that's got the same exit strategy you do. I've seen investors that are all about the IPO, right? Because they think it'll give them bigger returns, but it can take longer to get to the IPO. And then I've seen folks that say no, I'd rather you get bought by somebody else because that's the quicker path to my return, right? And you just don't know what's happening with the capital markets. Sometimes they're super volatile. So I'd say you just have to get on the same page. There's no right or wrong answer on that. There's just what's the best answer for you and how long you want to take to build your company before you exit. I mean, in the early days, so I started doing this 10 years ago. And in the early days, we were looking to invest in companies that would exit in 3 to 5 years. That's not, I mean, now we're talking 8 to 10 years, right? I mean, the length of time that it takes to actually get to a successful exit is much longer now.
Mm-hmm. Certainly. There's actually a question coming in the chat right now about board requirements and term sheets. So we've talked about how investors are looking for equity, some revenue, but you said equity is more up their alley. But what about these board seats and this kind of decision-making involvement?
Yeah, it's all part of the term sheet negotiation. I'd say be careful about board seats, right? First of all, when you have a new company and you're trying to grow and scale your company, you don't necessarily want a board directing every move you make. I mean, your board basically becomes your boss, right? if you are going to set up a board, I'd say initial boards, no more than 3 people. Please don't get talked into these 5 people, 7 people boards. It's too onerous. Board management takes a lot of time. So stick with, a very small initial board of 3 people. And that's your board of directors. That's different than your advisory board. Your advisory board can be much bigger. These people are not your bosses. They're your advisors. They're the people you go to. Like, I have a question about go-to-market, or I have a question about legal, or whatever. They're your advisors versus your board of directors, who actually vote on things, and you have to bring things to, and you have to meet with them monthly. It's just a lot of work. So early days, I would say be careful about a board. But by the time you're in your seed round and later rounds, you are going to be required to have a board. So just be careful and make sure that they have enough equity in this to make it worthwhile for them to have a board seat. Not every investor should get a board seat.
Great point. I'm going to shift gears a little bit. Allison wrote here in the Q&A box that Allison launched an equity crowdfunding campaign. In your experience, Kim, are angels more willing to invest within the campaign, or do angels want to invest outside the campaign?
It depends on the terms of the campaign, right? And it depends on whether I can get better preferred return on my investment by investing outside the campaign. I've done both, right? I probably like to invest outside the campaign just because I feel like it's more personalized, and I am a direct entry on the capitalization table versus, as I mentioned earlier, in these crowdfunding, like I'm just one of many in an LLC that then invests in your company. So I think it's, but it's a personal preference, and there are some investors out there that'd be just fine to do the crowdfunding, and they probably have more than one. They're probably doing a lot of different investments, trying to spread their risk.
That makes sense. And several questions have come in about, you shared the great do your research.
Right.
It all takes time. Off the top of your head, are there some great, for somebody who's never done this, sites to know? Is it TechCrunch? Like where should they be even looking to start this research like this? Is it like, find me a VC?
Well, actually, if you're looking for angel investors, there's a great site called angelcapitalassociation.org. And that site is everything you could ever want to know about getting an angel investor. There's education for you as a founder. There's also education for angel investors. And they have a page on their site that is nothing but every angel group they've ever heard of across the entire country. You can sort it by state that you're in and find angel groups in your state. They have hyperlinks. You have hyperlinks to the websites of these angel groups. And I see in the chat somebody's pitching tomorrow to the Angel Capital Association Southeast Investor Forum. And that's great because they run these events where all of their angel groups participate. And I think I mentioned as one of my points, if you can make one presentation and touch a bunch of angels, that's amazing, right? It's just so much easier because fundraising is hard work. And one meeting at a time is super hard, as opposed to pitching in front of an audience where you've got multiple at-bats, if you will.
Certainly. Several questions have come in about the math. So Rita said, valuing your company.
Right.
How do you decide the multiple?
Well, it depends. If you have revenue, then the multiple is going to be decided for you. So if you're a B2B SaaS company and you have paying customers, and let's say you have 500,000 of revenue, the typical multiple on a technology business in the market can typically be 6 to 10 times revenue, let's say. So at that point, maybe you have a $3 to $5 million company in terms of valuation. So if you've got revenue, those multiples will come to you. There's 2 things you can Google here. One is called the Burkus method, BERKUS method. And the other is called the risk factor summation method. And those are 2 of the most commonly known calculations for how you can determine your valuation if you don't have any revenue. And it puts a price on your management team, on your technology. It gives you a chance to say, this is why I think my company is worth $3 million.
Amazing. That's super helpful. And I guess it kind of relates to this next question around, are investors only looking for scalable businesses, or does craftsmanship or quality of service, like what matters most?
I wish I could tell you that quality and craftsmanship matter the most, but the reality is it's how quickly can you scale and grow to be a reasonably sized company that is going to give me a return on my investment. That's the reality of investors. We're here to make money. Ideally, we like what you're doing. We're passionate about what you're doing. We're willing to help you. But at the end of the day, this is an investment strategy for us. And so if you have a company worth $5 million today, and in 5 years, you're still only worth $5 million, my investment hasn't grown. But I have companies I've invested in when their valuation was $4 million, and today their company is worth $200 million, right? That's how I make my money, right? So put yourself in my shoes as an investor. I might like you as a founder, you might be really great, but if this is going to be a slow burn, it may not be the investment for me. If I'm looking to again, have a significant increase in my investment in some reasonable period of time.
Certainly. And I guess, Kim, that brings up, can we break down how you would define scalability for everyone?
Scalability means the ability to grow fast and get more revenue, right? That's really what scalability means. Sometimes it's scaling through people. A lot of times it's scaling through technology. It's a lot easier to scale with technology than it is to build a very intensive people business, right? Like I have a dog and I'm super passionate about dogs, and I got it pitched an idea to invest in a form of a doggy daycare, but it was at an apartment complex where they would go get the dog from your apartment, bring them, play, blah, blah, blah. And I was like, oh my gosh, this is amazing. I love this idea. But then I look at it, they need 100 workers for every $1 million of revenue. And these are part-time workers and different things, but just to kind of keep this thing going, I was like, that's way too people intensive for me, right? There's got to be other ways that I can find a business in the pet industry that can scale like that, but not need 100 workers. It's just so hard to find them. So my preference is towards technology scalable companies, but you could also be dealing with a company that scales through people.
Great. Well, Kim, I'm conscious of time. So if you could share one piece of parting advice for everybody out here as they embark on their equity financing journey, what would it be?
It's do your homework on the investors. That's the best advice I can give you. There's nothing worse than I get these inbound outreaches, and it's somebody who's pitching me something that's not even close to my investment thesis. My website says exactly what I invest in, who I invest in, where they need to be. We invest in women-led startups in the Southeast in these industries. And if you don't meet those criteria, why are you reaching out to me? I'm never going to respond to that, right? So do your homework, put together a personalized email that shows you've done your homework, and send that out. So that's my biggest piece of advice. Do your homework, because it shows when you've not done your homework.
Yeah. And that's not only valuing your time, but it's valuing your time as the founder.
Exactly.
Well, Kim, I cannot thank you enough. And for everybody who have tuned in today, we're so grateful, Kim, for your expertise and everything that you've shared with our community. And for folks tuning in, just a few